This week's biggest stories all share one theme: tariffs giveth and tariffs taketh away. GDP came in negative, but does that really mean the economy's in trouble? IBM thinks otherwise, dropping $150 billion to build America's tech backbone. Meanwhile, China is pulling back, turning West Coast ports into ghost towns and blocking Boeing jets. Micro Computer cuts guidance, and Wall Street wonders, is AI demand stalling or just shifting? And finally, we break down portfolio rebalancing, the overlooked tool that could keep your investments aligned in a market that's anything but. If you care about where your money's going next, you don't want to miss this. Hi, everyone. I'm Gary Brode from Deep Knowledge Investing. We work with hedge funds, family offices, registered investment advisors, and individuals like you to help you get better returns in the stock market. I'm here with our host, Rob Ferry, and he's the CEO and founder of Flying V, our digital marketing partner. Rob, we are meeting early this morning because you're traveling. Where are you right now?
Well, I'm actually home now, which is great. But yeah, today playing in a charity golf tournament. Big Brothers, Big Sisters out here in Orange County puts on an awesome event here in Newport Beach. So yeah, we're going to be out at that. But yes, I was traveling last week, was in Miami, had to make a trip to Phoenix, Scottsdale, Arizona area. So I had a lot of fun, a little bit of work, a little bit of play. But yeah, it was a great weekend. And happy Cinco de Mayo, too. I think we definitely need to call out that. I'm sure everybody
Absolutely.
Watching the show will be celebrating later today with a nice margarita. But Gary, yeah, how are you doing? How was your week?
Good. Actually, the big news that we talked about a month ago has now come to fruition. I am officially out of my home. A wonderful family is renting it for the next year, and I am homeless and adventuring and wandering throughout the world. I'm going to walk the earth like Cain for the next year. My first stop was Manhattan, where I'm staying with my old partner from Silver Arrow, Raji Kabaz. He's a member of the DKI Board of Advisors. And I had a chance yesterday to catch up with DKI advisor Lawrence O, another really close friend. So yeah, lots of exciting things going on. At the end of this week, I'm taking a 9-hour train to Pittsburgh to visit my cousins and my great uncle. He's 96 now. So it'll be great to catch up with all of them in person.
That's amazing. And just so everyone knows, Gary is homeless by choice,
Yes.
not because of the current recommendation on the DKI website. So just want to make that very clear to all of our listeners out there.
Yes, and my renters are kindly paying a very nice price for the year, and they'll be covering the expenses of the place. So financially, it all worked out really well. But I'm really excited about a year of adventure, travel, growth, doing better work, and self-improvement. I'm really putting together lists of the things I want to accomplish over the next year, and looking forward to doing that.
Amazing. Yeah, I'm really excited for you, Gary. So let's get into it. It's the 5 things to know in investing this week with Deep Knowledge Investing. This week's version of the show or the issue is called the Tariffs Giveth and the Tariffs Taketh Away issue. There we go with another classic DKI tongue twister. This week we're talking about GDP. IBM makes an appearance. We're obviously talking China and exports. Micro Computer makes another appearance. And then today for our educational topic, we'll be talking about what portfolio rebalancing looks like. Should you do it? Maybe what are some scenarios in which that could play out for you? So getting into it first, we're going to talk about GDP. First quarter GDP came in negative. We look at this and want to know, we're going to tell you why we don't think that this necessarily matters. Gary, thing number 1 right now, GDP, meh.
Hey,
great.
so
That's the shortest. I think that's the shortest thing in deep knowledge history. So that's great.
yeah, it's a Simpsons reference, kind of like, who cares? Although, Rob, I got a question for you from a marketing point of view. Is it a good idea to start an episode by saying to people, hey, listen to this, we'll tell you why the thing doesn't matter?
Yeah, exactly. No, it's a little bit of that reverse psychology, constant testing, right? You just throw it against the wall, see if it sticks. That's all we do.
Right, but for our viewers, if you're watching this and you don't want to know why we don't think the GDP number was important, you can just tune out right now, go on to the next episode. I mean, maybe don't do that, but whatever. It's up to you. So going back to the news here, last Wednesday, we got the first quarter GDP estimate, and that came in at negative 0.3%. Not a huge negative number, but it was a little bit below expectations of negative 0.2%. In addition to that, along with the GDP number, you get a PCE number, personal consumption expenditures, which gives you a sense of how much the inflation adjustment was made to the GDP number. And that came in 0.1% above expectations. So, the market got a little jittery early on Wednesday with the idea that we've got negative GDP growth worse than expected. We have an inflation number greater than expected. And, sort of there was this sense of, oh no. Now, my view is it doesn't really matter, thus the meh title on it. Let's go through the 5 reasons why. Number 1, the stagflation story that's highlighted by lower growth and higher inflation. People went crazy based on a 0.1% deviation from expectations. The US economy is far too large, and our economy is far too complicated to measure with that level of accuracy. I just don't think it matters that much. People were saying, oh no, 0.1% below. But if you can't measure to within 0.1%, I wouldn't get too wound up over a 0.1% deviation. Second reason, look, I'm often critical of the press, and reasonably so, but let's credit them. They nailed the big part of last week's GDP miss. Customers who were worried about higher future prices due to tariffs, so when tariffed goods start to come in over the next few weeks, we'll see price increases. And what they did was they bought goods in advance of higher expected prices. So imports subtract from GDP. This was just a massive one-time inventory stocking by both retail and consumers. It's a huge event, but it's a one-time event. And so, really understandable, doesn't tell us a whole lot about the economy. The third thing, this is something that the gold community has been focused on, but the press hasn't been. There have been massive inflows of physical gold into the US. Last week, I read a report that suggested that gold imports are so high that over the last 6 months, the inflows are equal to about 13% of the amount of gold stored in Fort Knox. That's a huge number. And remember, those imports also subtract from GDP. But let's think it through together. If the United States is importing physical gold, does that really tell us anything negative about our economy? It subtracts from GDP, but who cares? That's not a negative. That's not a bad thing. Number 4, the Doge efforts to cut wasteful spending. And again, whether your preferred party likes them or not, those efforts to cut wasteful spending subtract from GDP. And the US method of calculating GDP is so inaccurate that if the government wastes money, it's treated the same as actual production. So we cut some wasteful spending. Again, this is not a bad thing, but it makes the GDP number look worse. The final thing, and this is something that DKI talked about ahead of the election. We said that no matter whether Team Red won or Team Blue won or who was in control of the government, Congress was going to keep overspending. And guess what? That is exactly what's happened. Despite the fact that we have Republican control of all 3 houses right now, and Republicans claim to be the party of fiscal sanity and fiscal conservatism, they're not. They keep spending. And, the reason I keep referring to our finances as a Potemkin economy is because our GDP numbers are largely determined by congressional overspending. That's financed by debt and inflation. It doesn't really tell us a lot about the productive private economy, which has been in recession for a long time. So all of a sudden last week, people said, oh no, GDP is negative. And my response is the productive part of the economy has been in recession for more than a year at this point. So again, there's 5 reasons why you should not worry about last week's negative GDP report.
So Gary, we've been talking about this, for a few years now, this bifurcated economy, GDP not reflecting what's actually happening, as well as obviously government spending, inflating and ballooning that number, with Republicans continuously spending, and we see no signs of that stopping. So, what does this GDP number, what does it actually tell you for the health of the U.S. economy? What do you take out with any of the information that does come out of this number?
So I don't think it tells us a whole lot, Rob, or really anything. Just like over the last year, we've said every one of the GDP numbers we've gotten has been meaningless. And the reason for that has been huge amounts of debt fueled spending by both parties, by both Team Red and Team Blue, have just created this fake sense of the GDP of the country. And, as a reminder, wasteful government spending is counted the same as actual production. And that's, I think, an error in the way that we account for things. The big change. I mean, listen, it's interesting to talk about gold imports and, more government spending on consumption, not production, which again is true. But the big thing here was the massive surge in inventory stocking ahead of expected tariffs. And, for those of you who are checking out the written version of the five things, Cashin did a fantastic graph showing just the magnitude of our net imports, where the number just falls off of a cliff. And that, I think, that was a huge one there. Basically, all it tells us is that when people think prices are going to go up, they do a lot of buying in advance. So I don't think we have any new information about the economy. I don't think it's doing any better or any worse than it was 3 months ago, 6 months ago, 12 months ago.
Makes sense, and we'll keep eyes on everything moving as it relates to quarter two GDP numbers and whether or not we can put anything into that. Gary, moving, we're going to talk about IBM. They committed to spend $150 billion to expand U.S. production, mainframes, quantum computers, tariffs for the win. We have there in the written version of the five things. Gary, thing number two, IBM makes major U.S. tech commitment. Huge news.
Yeah, so again, I am really excited about this one. I think a couple of weeks ago, we took a victory lap for the country when we found out, that NVIDIA had started high-end production of their Blackwell chips here in the US. IBM, is the next one in line, just announcing $150 billion of commitments into U.S. manufacturing. That'll happen over the next 5 years. The plan is to expand its American mainframe and quantum computing systems. This is the high-end stuff that needs to be done. IBM cited that they wanted to avoid supply chain shocks, and they're deepening their U.S. manufacturing footprint. These new mainframes that are going to be produced in the U.S. will rely heavily on AI systems. And so, IBM noted that scaling AI isn't just about software, but also the underlying hardware, which U.S. manufacturing is going to be able to produce. We think this is a huge win. It's one of the largest shifts in tech production that, we've seen in my lifetime. I'm sorry, by shifts, I mean shift back into the U.S. as opposed to the constant outsourcing. In my opinion, having more ultra high-end technology hardware manufacturing being done in the US is best case scenario from the tariff situation. So we're excited about this one.
Gary, with this, obviously we've been talking tariffs this entire year. Both sides arguing for and against them in regards to what President Trump's doing. Does this show progress that this economic plan is working? Is there gain that's to be paired with pain, or maybe that initial reshuffling and pain that we're seeing when these tariffs were announced or conversations started around these tariffs?
Yeah, so, Rob, one of the things that I think President Trump has done that was very smart was he didn't say, he says tariffs will be wonderful and marvelous and huge and terrific. He's a man who likes to speak in superlatives. But he was also honest with the American people and said there's going to be some pain, right? This is going to be uncomfortable for a while. And he's right about that. The truth is the United States has spent the better part of the last half century selling off our manufacturing capacity, reshoring that, rebuilding, training people for that. None of that is going to happen instantly, and there will be some pain up front. But again, this kind of new high-level technology production, like we talked about with NVIDIA producing their Blackwell chips here, now IBM with $150 billion of AI-based mainframe and quantum computing production here, that's the best possible outcome from this tariff-driven reshoring. Again, it is going to take some years. We're going to take some pain first. But if this ends up with us reversing years of industrial capacity that's been migrating to international locations, it'll create thousands more highly skilled jobs and technology clusters. here in the United States. This is stuff the United States has not seen in years. So we're excited to see it. I think it is definitely a huge plus for the country. And one of the things that I've said all along is I would like to see people be honest about the totality of their arguments. Right now, the pro-tariff, pro-Trump people are saying, look, we have all these new jobs, and they're ignoring the costs and the pain that we're going to take, and that's not completely honest. On the other side, every week on FinX and in the Wall Street Journal, I'm reading about people castigating the president for tariffs. They're saying it's horrible, it's terrible, it's the worst economic decision they've ever made, but they're ignoring literally trillions of dollars of new investment in the United States. They're ignoring tens, maybe hundreds of thousands of new high-tech jobs that are being added. And that should be part of the conversation. All I'm saying is whether you're in favor of tariffs or against them, when you have a discussion about it, you should be able to understand and articulate the good points on the other side and evaluate the whole situation in its total complexity. And that's what we're trying to do here.
Yeah, makes total sense, Gary. And in terms of just letting everything play out, I think that's part of what we need to see happen as well. And we'll talk more about that coming up in this next point. You'll know what I mean in a second. But before we do that, you're watching this week's version of the 5 things the tariffs giveth and taketh away issue. Please subscribe to our YouTube channel. Give us thumbs up, thumbs down if you disagree. Tell us why. Have some conversation and discourse in the comments. And as always, you can head to our website, deepknowledgeinvesting.com. Put in your email to the pop-up. You'll be added to our email list, receive all of our new posts. Some of those will be paywalled for premium subscribers who get access to all content and obviously current recommendations and buy and sell alerts when Gary's making moves within the portfolio. Moving to thing number 3, we're talking China. Now on the opposite side, they've cut exports to the U.S. I was actually in Miami, Brickell area, and was there for 3 days, and I did not see one thing moving over in that port area of the city. So, yeah, I'm not sure that means anything, but could have something to do with this. Tariffs for the loss, now we're saying, depending on your point of view, Gary. Gary, thing number 3, China cuts back.
So for the people who are tuning in to this particular segment, thing number 3 for this week, in thing number 2, we talked about some of the benefits of tariffs with IBM agreeing to $150 billion of mainframe and quantum computing production here in the United States. And my point in all of that was to say to people, we think that these should be full, complicated arguments. The pro-tariff people should acknowledge the pain that's going to be caused and the more expensive goods that we'll have. The anti-tariff people should acknowledge the new production, better supply lines, and new jobs from that. So in an effort to be intellectually honest ourselves, we're going to talk about some of the downside of tariffs, which is what Rob introduced. As a result of our spat with China right now and much higher prices on Chinese goods, as a result of tariffs, there is an expected 35% decline coming at the port of LA. We've read reports that the port of Seattle is a ghost town right now due to a decline in shipments. So you have all of these places where we're used to having a lot of people working, bringing in low-priced goods, and that has ground to a halt or at least slowed substantially. Rob is reporting he did not see a whole lot of action in Miami, which is not as big a port for the U.S. as the port of LA, but it's not nothing either. In addition to all of that, Beijing recently ordered airlines to stop any new Boeing jet orders, and they began rejecting delivery of orders already placed. Now, Boeing is a huge exporter. They've already adjusted to these market changes. They just delivered those planes to other waiting customers, so good for them. But, I think it's important to note that these developments where China is shipping less, they're raising their tariffs on U.S. goods, they're rejecting Boeing planes despite having contracts. I think that shows China's reluctance to work toward a trade deal and that they're maybe not operating in good faith. China's retaliation isn't just affecting the U.S., and as the world's largest exporter, their choice to seek new buyers has the ability to change the landscape of trade across the globe. And one of the things that I think is not likely but is possible is a decoupling between the US and China. It's not the most likely outcome right now, but it's something that is being discussed, and it may be something that we need to do at least partially.
Gary, with these tariffs, right, and obviously China's reaction to this, should consumers expect that they will start to have to pay more for these Chinese goods that actually are still coming to the States?
Yeah, I think that is something that people should be prepared for, and a lot of retailers. So one of the things we talked about in our first segment with the lower GDP is we had a lot of inventory stocking ahead of higher tariffed prices, um, and so the reports I've read say that most retailers have about 2 months of regularly priced inventory left. And so, future potential shortages and price hikes have American consumers worried. One thing I think is really interesting is it seems like most retailers are actually using a specific inventory model on this. So if they imported, like if you wanted to buy an item, and your retailer of choice imported that item before tariffs went in place, they'll sell it to you at the pre-tariff price. And then when the tariffs go into place, they're saying, well, we've got 2 months of regularly priced inventory left. After that, we'll have to start charging more. So what's really interesting to me is the retailers' prices are not necessarily following policy in order. They're following specific pieces of inventory. So basically, what I'm reading is depending on the item that you're looking at, you probably have about 2 months.
Understood, and we'll keep an eye out on that in terms of what prices we're seeing, what China's reactions will be. Still a lot to play out in this particular space, and we'll be keeping you up to date on everything as it does happen. Gary, moving to thing number 4, we're talking super micro computer. They actually cut some revenue guidance. Seems like every other week, right? Going back and forth. What does this AI infrastructure spending look like? What are the forecasts? Do we really know? Is everyone guessing? Gary, you're going to break it down for us in thing number 4. SMCI, super microcomputer, slashes revenue guidance. Does it matter?
So over the last couple of years, Rob, Supermicro Computer is a company that has benefited an enormous amount from this shift toward AI spending. And they make the kind of machines and servers that companies are using for, in AI data centers. They recently cut their third fiscal quarter revenue guidance. That's this quarter for them. And what's really interesting about it is they forecasted a 17% decline. And the thing that I want to emphasize is that wasn't their growth rate got cut by 17%. It wasn't like their growth rate went from 50% to 33% or something like that. They're forecasting a 17% decrease. They're looking at declining revenue here. Now, they blamed delayed customer platform decisions for pushing sales out to the following quarter, and they, of course, reduced their estimates. And so it raises the question over whether big tech companies will reduce data center spending in the coming months, or whether the spending is going to continue. And Supermicro was right, and they basically, their customers just said, we need a little more time to figure it out. Basically, in another 3 months, we will find out. We'll see if their business is declining or if orders were just pushed out by a quarter. This is a situation where Wall Street sold the stock immediately. While I'm not normally a fan of knee-jerk reactions, I think the professional investors got it right on this one. If a company says we're looking at a 17% decrease in revenue, but don't worry, we'll pick up all those orders again the next quarter. And your investment plan is, well, let's cross our fingers and hope that those orders were just delayed. That's probably a pretty bad plan. When you're looking at a situation like that, I think it makes sense to lighten your exposure, because to me, the probability that 17% is going to come back, roaring back next quarter, and people just needed to figure it out, it's possible, but I don't think it's the most likely outcome.
Yeah, so Gary, if Super Micro's cutting revenue estimates, I mean, how much or what does that mean for the rest of the sector, just in terms of forecast guidance? How much of that are you going to blanket over the rest of the sector?
Well, I think it means two things, Rob. One is if super microcomputers customers are saying we don't really need as much AI related hardware, then that is bad for the sector. That's not just super micro. That's going to be bad for Dell. It'll be bad for Nvidia. Certainly not good for AMD. The memory makers like Micron. That's not a positive for anybody in the business. Beyond that, one of the things that everybody has noticed is these AI related and high multiple technology stocks, they tend to be very volatile, and often the entire sector will trade as a group. So, for example, if Supermicro announces, bad results, you'll often see the entire sector trade down, even if there's no fundamental news at any of the other companies in there. Like the whole sector will often trade together. And it's something you'll often see with, like Nvidia or Meta or Google. Sometimes they'll have bad results and they'll just take down the entire sector. And so, you should expect to see continued volatility, and a lot of times you'll just have stocks trading as if there's something going on with them, and what's really happening is a competing company or supplier or customer of that company, they've got their own issues.
Yeah, great stuff there, Gary. And we'll keep eyes on everything happening in the AI space and what this means moving forward. Obviously, deep knowledge investing super on top of that sector, just based on a few of our portfolio positions. You're watching this week's version of the 5 Things to Know in Investing with Deep Knowledge Investing. The tariffs giveth and taketh away issue. Please head over to deepknowledgeinvesting.com. Sign up for a free subscription. You'll be added to our email list. Get notified of new versions of the 5 Things, as well as other content being produced through the site. We'll also have a section on the site that is the Ask Gary section. You could submit a question, might end up on the show here for you to review and hear Gary's answer. And as always, if you consider a premium subscription, $100 a month, that'll get you access to everything you can imagine on the website, and exclusive access to Gary in some instances as well for support and questions, right? That a lot of our subscribers bring to us that can be quite complicated. And Gary, I know you do a great job of walking everybody through those. This week, for our educational topic, the fifth thing, we're going to be talking about the importance of rebalancing portfolios. What is that? Should you do it? Gary, why don't we start with give us a high-level overview of what it means to rebalance a portfolio.
All right, Rob. Well, let's imagine that, you decide to start investing in your 20s. And, you go speak to a registered investment advisor or somebody, an investment professional, and they say, hey, listen, for somebody like you, we're really recommending that you be 100% in stocks, or maybe, 80% in stocks, 20% in bonds. And you say, okay, well, that sounds good. And you put your assets in there, and then two things will happen, Rob. One is you're going to get older over time and take on responsibilities, potentially like getting married, like having kids, like having a home. And those can be wonderful decisions. They can also be expensive decisions. And then when you get much older, your investment time horizon decreases. You don't have as much time to make up for investment mistakes. And so a lot of times advisors would recommend going to the perceived safe haven of bonds, and having less equity exposure. Those assets tend to be more volatile. um, the second thing that will happen is the value of your investments will change around. Over the last however many years, we've seen a generally rising stock market, certainly not all the time, but the market's gone up a lot in the last couple of decades. And so you could have a situation where certain of your assets, certain of your stocks have done really well and become a bigger part of the portfolio. That's particularly the case for people like DKI subscribers who own huge amounts of Bitcoin and gold. Like we've had a phenomenal year. But for many of us, when, we started buying Bitcoin in the $15,000 to $20,000 range, now that it is roughly 4, 5, 6 times that level, depending on the day. A lot of the Bitcoin we bought, it's up 6x. It's become a huge part of the portfolio. And so there's a question: should you rebalance? Should you trim your larger positions and buy things that haven't done quite as well? And also, should you change your allocations as you get older and your investment time horizon shortens? And so that's what rebalancing is. It is saying, over time, I started like maybe 80-20, 80% equities, 20% debt. But, maybe over time, the equities have done well, the debt hasn't done well, and you might be more like 90-10 or 95-5. And then if you added assets like alternatives like Bitcoin or gold, sometimes people added those as like 5% positions. Those might be 25-30% positions now. And instead of having a 5 or 10% allocation to alternatives, people are finding they have a 30 or 40% allocation to alternatives. So rebalancing, whether you want to do it or not, would involve selling off some of those assets, bringing them back down to the 5, 10, 20% range, and buying some other things that maybe haven't done as well.
Gary, just in terms of best practices, when should people rebalance? Should they do this regularly? What's kind of your recommendation in terms of how to look at the timeliness of rebalancing?
So it's a really good question, Rob. And a lot of it has to do with, if you're watching this, it has to do with your age, your personal circumstances, and your appetite for risk. Right? There's no free lunch on any of this. And so a lot of this really does depend on people's individual circumstances. Here's what I view as the plus and minuses of it. The positive of rebalancing is it forces investors to sell assets that have appreciated in relative value, and then they buy assets that have depreciated against the rest of the portfolio. And so to a certain extent, it forces people to sell the stuff that went up and buy the stuff that is more cheaply valued. And that seems to make sense. But it violates a key rule of that a lot of traders follow. And the reason they object to that is they prefer to let their winners run and cut losses quickly. And so, in those situations, they're saying, wait a minute, why would you cut your winners? Why are you buying your losers? Like, from a trading point of view, it doesn't really make sense to a lot of really good traders. In my opinion, I don't think there are best practices in this matter, and that your portfolio should reflect both your current risk tolerances as well as the opportunity set for your best investment ideas. So, as an example, rolling into 2020, my portfolio was 100% equities. And because of, the amount of stimulus that got thrown into the economy in 2020 and what the government did there and seeing inflation coming, I started to buy positions for the first time in gold, a small position in silver, and a large position in Bitcoin. And those have become massive parts of my portfolio. But one of the reasons they were able to do that is I let them run. The key thing here is, in my opinion, the opportunity set changed. In 2020, I wanted to be long. By the end of February of 2020, I had huge short positions against the market. And by the end of 2020, I had large positions in gold and Bitcoin and a small position in silver. And so for me, it wasn't that my risk tolerance changed or that my age changed that much. It really was more a matter of the opportunity set in the market change. And I think that's something that Deep Knowledge Investing has been able to do for our subscribers, where we've said, hey, listen, we've been investing in this way because these are the circumstances. And when the market changes, when the Federal Reserve changes, when inflation changes, when the macro environment changes, we've often said we're going to shift our investments. We're selling this, buying this. Now, our subscribers, they can agree, they can disagree, they can do what they want with it, but they at least get a very clear idea of the reasons and the timing of when I'm rebalancing my portfolio. In my case, I'm not doing it because of age or to take money off the table. I'm doing it because I see the opportunity set in the investment landscape changing.
Yeah, I think that's a great point, Gary. And I think huge value for me personally, DKI is, it's one thing to buy a stock at a certain date and time when you think things are good, but it's a dynamic market, right? Things change, new policies come into play. And I think that's what DKI does really well, is keeping everybody in tune in what's happening, what does the market look like, regardless of the landscape. Here's how we're going to help you position to make money in that particular market. And a lot of times that is changes, quarter over quarter, or year over year. It's not just sitting and waiting and letting things happen. So it's that active investment, which has been great. Gary, I guess last question on this topic is, what would be an objection that someone might have or a trader might have to portfolio rebalancing?
I mean, there are a couple of them. One is the one that we cited earlier, which is it means selling your winners and buying your losers, or buying things that haven't done as well. And a lot of traders don't like doing that. Another one would be a lot of times rebalancing is done to maintain certain assets in your portfolio. But what if the landscape has changed? So again, the example that I gave before is prior to 2020, I'd never owned gold. I'd never owned Bitcoin. And when the government throws massive amounts of stimulus into the economy, I was looking for inflation hedges. I was looking for things that would do well as the dollar declined in value. Now, had I said, okay, well, my ideal allocation is 5% Bitcoin and 5% gold, then and kept selling them every time they went up to 6 or 7 or 8%, I would have left an enormous amount of money on the table. That I see continued upside for these things, and gold has more than doubled since we bought it, and in my case, Bitcoin is up more than 6x since original purchase and since some supplementary purchases. And so, we would have left a huge amount of money on the table. Now, it's not necessarily a bad thing to rebalance in the case of a professional investor, where I'm spending all day, every day, looking at the market and tracking these things and thinking about different investment opportunities. That's not something that I want to be doing. I want to be able to figure out, what do I think is the upside from here. So, I think rebalancing keeps things easy. I think investing continuously is more difficult, but if this is what you do every day, then it's not that big a deal.
And that concludes this week's version of the 5 Things to Know in Investing, the Tariffs Giveth and Taketh Away issue. We'll be back, same place, same time, maybe different place, different time.
Different place.
Yeah, but we'll definitely have a recording up and at it, as we normally do on Mondays, to get this published and posted. Thank you so much for joining us. Again, head over to our website, deepknowledgeinvesting.com, for more info. Give us a like, a follow if you found some value out of this video. If you didn't, please give us a thumbs down and let us know why. That's the only thing we ask in that front. Gary, as you travel, wish you the best. That's really exciting for you. It's going to be fun to see what transpires over the next 12 months. But Gary, I'll turn this over to you and leave you with the final thoughts for today.
Yeah, so really great week for me. I got out of my home, and the new family there. They're really terrific people, and I've had this past few days to spend with 2 of my closest friends and 2 people who are members of the DKI Board of Advisors. I'm excited to catch up with my cousins and my uncle at the end of this week. Certainly excited to see Howard Friedland, who's also on the DKI Board of Advisors. So really, that first month of being out of my home is about connecting and reconnecting with people, both personally and business related. I'm excited about that. Also, really want to take a minute to celebrate DKI intern Cashin Crow. When we brought him in, he was the most inexperienced intern we've ever brought in. He was halfway through his freshman year of college, and I saw something in him, but my view was, all right, we're going to need to train this guy. He's going to be good, but it's going to take some time. And that's okay. And Cashin has surprised all of us by getting himself up to speed very, very quickly. At this point, he's really taken ownership of the 5 things. So much of what you heard today is a result of his hard work, his solid research, his really great job picking topics. Cashin has become a real contributor despite his young age and just very small time on task. I'm excited to see that. As always, we want to thank the team at Flying V, who's terrific. And for those of you who are watching, we know your time is valuable. Thank you for spending it with us. If you choose to subscribe and put on notifications or give us a like, that would be great. If not, we're not the boss of you. Do whatever you want. Either way, we will be back next week with a new 5 things. Thanks so much.
Thanks, everyone.